People are white-knuckling it right now, holding off on buying a house, just waiting for mortgage rates to finally drop. Everybody stares at Washington, decoding Jerome Powell's press conferences, assuming the Federal Reserve dictates exactly what it costs to borrow. But the Fed only directly controls short-term, overnight interest rates. They do not set the long-term rates that actually dictate your 30-year mortgage. Those long-term rates, like the 30-year Treasury bond, are set by plain old market forces: how much government debt the United States is selling, and how many people around the world actually want to buy it. If the global appetite for American debt dries up, the cost to finance a house is going to stay painfully high, no matter what politicians in Washington decide to do. Right now, the U.S. Treasury has to sell a staggering amount of new debt every year just to keep the lights on, and its single most reliable customer is quietly walking out the door. That customer isn't in Washington. It is a man you will probably never meet, sitting in an aggressively boring office tower in Tokyo, deciding where to put his country's money. To understand why a Japanese money manager gets a vote on your mortgage, we have to look at how a desperate economic band-aid applied in 1990s Japan accidentally became the load-bearing pillar of the modern American housing market. We have to rewind to 1992. Japan had the hottest economy on Earth until its massive real estate and stock market bubbles violently burst. The country walked straight into the lost decades, 30 years where economic growth flatlined, where average wages froze and inflation dropped to zero. The Bank of Japan did what central banks do when they run out of ideas: slashed interest rates to zero. When that didn't work, they rolled out something called yield curve control. The central bank promised to artificially cap long-term interest rates, putting the cost of borrowing money into a medically induced coma. This stabilized the bleeding, but it created a massive headache for Japanese pension funds and life insurers. They needed to generate returns for millions of retirees, but their own government's bonds now paid absolutely nothing. Picture a Japanese fund manager. He has retirees expecting a check every month, and holding domestic bonds yielding 0% is a fast track to losing his job. So he uses a workaround. He borrows massive amounts of Japanese yen at zero cost. Next, he converts that yen into American dollars, buying U.S. Treasury bonds paying 5%. He borrowed at zero, earns 5, and pockets the difference. This survival tactic is the yen carry trade. It became a permanent pipeline, silently pumping cheap money out of Tokyo and heavily into Western financial markets. This tactic spread instantly. Every major bank, life insurer, and pension fund in Japan ran this exact same playbook simultaneously for 3 straight decades. Trillions of dollars of Japanese capital flooded outward in a massive global hunt for yield, making Japan the single largest foreign holder of American government debt on the planet. Because they were relentlessly buying U.S. bonds, they artificially inflated the demand. That constant, guaranteed buying pressure is what kept American corporate debt and household mortgages impossibly cheap for an entire generation. In 2024, the math broke. Japan finally got the inflation it had been chasing, and the central bank was forced to end yield curve control and hike interest rates. The second they hiked, the core logic of the carry trade flipped upside down. Borrowing in yen suddenly cost real money, erasing the profit margins and making those American treasuries look a lot less appealing. When free money stops being free, investors sprint for the exits. We saw a dress rehearsal of this panic in August 2024, when an unwinding of the trade vaporized trillions in global market value in a matter of days. The overarching trend is clear: repatriation. After 30 years of hunting for yield abroad, Japanese capital is turning around and coming home. This sets up a brutal collision for the United States. The Treasury is running massive annual deficits and printing record amounts of debt, right as its most reliable buyer starts skipping bond auctions. It is pure supply and demand. When you have a massive supply of new debt and falling demand from foreign buyers, the only way to convince new investors to show up is to pay them more. Yields on long-term treasuries have to climb. And because the bond market acts as the baseline for all other loans, corporate borrowing gets expensive. Companies pull back, hire less, and cancel expansions. That same baseline applies to housing. The 30-year mortgage moves in lockstep with long-term treasury yields. If global demand for American debt weakens, your housing costs will refuse to drop. The people who eat the cost of this shift are never the hedge funds. It is the small business owner facing pricier credit, or the couple who finally saved a down payment only to find the monthly numbers still don't work. We obsess over the loud political risks on the evening news, but the risk that actually reaches into your wallet is the boring, unclickable bond market, quietly shifting the price of money everywhere, all at once.